Welcome to the Medfaber Show, where the focus is on helping you grow and preserve your wealth. Join us as we discuss the craft of investing and uncover new and profitable ideas, all to help you grow wealthier and wiser. Better investing starts here.
Medfaber is the co-founder and chief investment officer at Cambria Investment Management. Due to industry regulations, he will not discuss any of Cambria's funds on this podcast. All opinions expressed by podcast participants are solely their own opinions and do not reflect the opinion of Cambria Investment Management or its affiliates. For more information, visit CambriaInvestments.com.
Welcome back, everybody. We got another awesome show today. Our returning guest is Dr. David Kelly. Dr. Kelly is the chief global strategist and head of the global market insight strategy team for JPMorgan Asset Management. He also publishes notes on the week ahead, which is read by over 100,000 people. Dr. Kelly, welcome back to the show.
Glad to be here, Matt.
Last time we had you on, which would have been January of 2023, I think. It's been a while. I asked you, what sort of view did you hold that most of your peers didn't hold? I'm going to read you your answer. You're probably long forgotten this. It said, I think this was a brief cameo from inflation and it's going to fade again. Hey, you get to take a little victory lap. I think you end up being right on this one. You want to tell us about it?
Yeah, and I feel good about that. I mean, it's nice to have a prediction that actually comes true and somebody reminds you of it. But yeah, this economy is not an inflation-prone economy. And if you look at what happened with inflation in the 1970s, it spikes up and then it spikes down in almost the same way. And that's what happened. We had the pandemic, which messed up supply chains. We had the policy response, which was very important in giving a lot of money to lower and middle-income households. They spent that money, pushed up the price of food, pushed up the price of energy, pushed up the price of all sorts of core goods. And then you had Ukraine, and that further amplified. And so by the summer of 22, we were up at 9.1% year-over-year inflation. But everything that I've seen about the operation of the U.S. economy over the last few decades suggested that when you begin to fade those things, when you get rid of the pandemic aid, when you try and get back to normal, in that sense, and even as the world adjusts to the supply shocks caused by Ukraine, once that happens, inflation will come right back down to 2%. And that's exactly what it's done.
So when you start to think about what's transpired in, what is that, almost year and a half, almost 2 years since then, it seems everyone was always wringing their hands, upset about this impending recession. But it seems like times are kind of good. You want to walk us through kind of what you guys are seeing right now?
We never declared that we thought we'd see a recession. I think we were careful not to make that call. And, long experience watching American consumers makes me an optimist on this. I mean, we have the most reckless consumers in the world. They are more willing to spend money they don't have on stuff they don't need than anybody else. And that really has powered us through this. And even in the third quarter of 2024, we saw real consumer spending growing at a 3.7% annualized pace. We're seeing broad gains in consumer spending across the board from richer people because of huge gains in the stock market and household wealth. But even from lower and middle income households, we're seeing good gains in things like food and clothing and energy spending because we've seen 18 straight months of rising real wage gains. Wages have been going up faster than inflation. So I think people still feel like they're grumpy about high prices and don't ever expect those prices to get back down to where they were before the pandemic. But the rate of change in prices has come down, and that has allowed the average American to get a little bit ahead of the game, and that's kept consumer spending going. So I think that's the biggest part of it. I think we've also seen pretty good spending on AI. Corporate profits are very strong, and I think corporations are willing to do some capital spending. And that's just really kept us going here. Inflation's gone away, but it wasn't because of an economic slowdown, because that slowdown just didn't occur.
It feels like the sentiment of the consumer, if you were to tell me kind of everything the way it looks, I would assume it would be a lot more bubbly, but it seems kind of dour. Is that the case? What are the surveys kind of saying? The consumer doesn't seem like should be as happy as they should be.
They should be a lot happier than they are. I mean, one of the ways I measure this is there's an old index which you call the misery index, and that's just the sum of inflation and unemployment. You take the CPI inflation rate, you add on the unemployment rate. Well, right now the CPI inflation rate is about 2.4%, unemployment rate running 4.1. You add those together, 6.5%. That is lower than it's been 87% of the time over the last 50 years. And so, that's actually a sign of a pretty healthy economy. But yet, consumer confidence is down in sort of the bottom 20% of the last 50 years. So people don't feel good, even though the numbers suggest that they probably should. Now, I think, what's causing it? I think one of the reasons is it has been unequal. And consumer confidence surveys count by people. Everybody gets one vote. But the economy doesn't count by people. The economy counts by dollars. And so the spending of richer households is much more important for the economy than the spending of poorer households, because they just don't spend as much money. They don't have as much money to spend. So the economy can be doing pretty well, but it won't feel that great to all the households. And that's an issue. But also, I think this the prolonged election campaign, the social media feed that people get, basically all these algorithms, whether it's in conventional media, social media, what they're basically designed to do is make you scared and make you angry. And we've got a population that's walking around scared and angry. And I think to some extent we are manipulated into that perspective. But that certainly makes people take a negative view on the economy, as well as many other things.
This is actually a pretty profound insight. You had a quote earlier this year in Barron's that we pulled out where you said, often at speeches, people ask me for advice. I say, get a pitcher of water and a baseball bat. And if you would kindly drop your cell phone into the pitcher of water and take the baseball bat to your TV, you'll feel much better. And I wonder how structural this sort of social media degradation of mental happiness is. I was watching the World Series with my 7-year-old, and I joked on social media. I said, hey, this is really a special time. My son and I get to watch the World Series, and I finally get to explain to him what erectile dysfunction, psoriasis, transgender surgery. We spent like 3 innings talking about side effects because every single advertisement was like a pharmaceutical advertisement or some terrible political ad. I'm like, how are any of these appropriate for a young kid audience that's the World Series? But I wonder if there is an actual structural input to the samples because people are struggling with some of the inputs you mentioned.
Oh, absolutely. There's actually a very good book written recently called, I think it's called The Anxious Generation, just about the effect that the introduction of smartphones appears to have had on teenagers since 2012 when they arrived on the scene. And just, literally you can see rising levels of depression, rising levels of anxiety, people scrolling, losing sleep, people sort of comparing themselves to other people on social media. It's very detrimental to people's health. You walk along the street, people have all got their heads in their phones. Humans are not built to do this. Humans are built to look at other people in the face. We're getting this synthesized life that we're looking at over social media instead of the real stuff. So I think it's dividing us. Again, a lot of the messages are designed to make us angry and scared, because that's what tends to cause humans to react. And that's, Madison Avenue learned that years ago. The problem is they've got so many more tools at their beck and call. And so I think it has a profound effect on us as human beings. And we should really think about, doing something radical to try to de-wire ourselves from some of this stuff, because it's not doing us any good.
All right. Well, when you figure it out, let me know, because I'll be the first to sign up for Dr. Kelly's service here. There's one area of the world where people aren't sad and grumpy. And there was, I don't know if you saw it, yesterday's report from the conference board was talking about where they asked investors, do they expect higher stock returns in the next year? And I believe it was the highest reading ever on record going back to 1987. So maybe there's one area of the world they might be interested in. That's with U.S. stocks at all-time high. But a lot of the other sentiment surveys, may or may not agree with that, or at least not as crazy as they are with the AI survey. And then the one that does rhyme with that is the percentage of household net worth that's allocated to stocks is, at these all-time highs. Talk a little bit about that, about kind of this wealth surge, what kind of implications this has as well.
Well, first of all, on your first point, that is a big contraindicator. Because when everybody feels very optimistic about stocks, it usually means all the available money is now in the market. Of all the things we might talk about, that's the most worrying sign for the stock market. But there has been an enormous surge in wealth. I wrote something about this a few weeks ago. We estimate that the net worth of all American households rose by $50.1 trillion in the 5 years that ended in the third quarter of 2024. 50.1 trillion. I mean, to give you a sense of how big that number is, the growth in the federal debt over that 5-year period was $11 trillion. But this is $50.1 trillion, and it's had a profound effect. And it's because what's happened is we've had two massive booms at the same time. We've had a massive boom in the stock market, but we've also had a massive boom in home prices. And while those higher home prices are locking out a lot of Gen Z families from ever buying a house, and millennials too, so there are a lot of detrimental aspects to it. But 2/3 of Americans actually own a home with or without a mortgage, and they've all seen a significant increase in home equity, almost all of them. And that's really a part of a big explosion in wealth. So this isn't an economy that's worked for everybody, but it certainly has worked for investors over the last few years.
There's a stat that I came up with recently, and it's technically not concluded because it's a year-end stat. But when I did it, it was as of year to date. And that was the number of times both gold and stocks are up 25% in a year, number of times that's happened in history. And the answer is 0. And I'm not really including 1933 because, it was kind of illegal to own back then. But there's some weird forces kind of going on. Is that something that surprises you to kind of see gold and stocks both romping and stomping this year? Or is it creating some sort of offsides imbalances? What do you think?
Not particularly. So I think that this surging stock market is having a lot of side effects, because what's happening is people's portfolios are getting completely out of whack in terms of balance. And so every quarter people are looking at them and feel, I'm very rich, but boy, should I have all my money in the stock market, particularly if all my money is in US stocks and it's so concentrated in just those Mag 7 stocks. So maybe I ought to diversify, reallocate. Well, how do I diversify? Well, I suppose I better buy some bonds. And so we've seen long-term interest rates, I think, be lower than they otherwise would have been, because people are trying to desperately buy some bonds to try and balance it out. But also people say, well, I should be in some alternatives. And I heard from somewhere that there was going to be inflation, or inflation might come back. Maybe I should hold some gold. And what it's doing is this tidal wave of rising stock wealth is actually causing these ripples into all these other markets as people try and rebalance portfolios. I think it's leading to high valuations within the bond market. It's leading to tight credit spreads. I think it's leading to a lot of interest in alternative assets. And if gold's one of those alternative assets, then it's leading interest in gold. I think that's part of it. I would also say there may be an issue with just the boom in the Indian economy, because the Indian public, like no public on earth, loves gold. And so if India is doing really well, gold prices usually go up.
That's a great point. How much of this, I wonder, is what's going on with the dollar? I know you've talked about the dollar being on the expensive side. And it's always funny when you have a political election going on in seasons of what everyone's talking about, because people talking about the dollar being, we want a strong dollar, but the dollar's too high and China's doing this and somebody's doing that. What are your thoughts on the dollar today, and expensive, or where do you think it's going to be, what we should be doing, where it should be going forward?
Well, I think the dollar is too high. My best evidence of that is the United States has not run a trade surplus since 1975. We've run a trade deficit every single year since then. People don't want to buy our stuff because it's too expensive, and we want to buy their stuff because it's cheap, and that's because the dollar is too high. And that may sound like, well, that's nice, we can buy cheap stuff, but it has served to decimate US manufacturing. And a lot of the empty factories in the industrial Midwest, a lot of the people that sort of find themselves in dead-end jobs or ghost towns, has come from having a dollar that we allowed to be too high for too long. I mean, the very phrase strong dollar, weak dollar has sort of a judgment in it. But why should we want a high dollar? I mean, the dollar is not our national flag. The stars and stripes, absolutely, fly it as high as you can. The dollar is an economic instrument, and you want to set it at a level that does you the most good. And the level that does you most good is one that would be probably aligned with having a trade balance rather than a trade deficit running at over $1 trillion a year. So I think the dollar is too high, and I would like it to come down slowly. I think that is a much better policy decision than to try to get into a tariff war or trade war. But there are things that the government could do if we set about it to bring the dollar down gradually. And I think we should work with trading partners to try to get them to help with that. And if we can bring the dollar down to a level which is in the long run consistent with trade balance, I think it's just more healthier for everybody. So I do think that we should try and bring the dollar down gradually. And I think ultimately, because any other solution to a trade deficit is just counterproductive, I do think we will ultimately make that decision as a country that we need to just try to bring the dollar down.
I was wondering at what point the big T word would come into play, and that being tariffs. This has been, of the word cloud, probably the most discussed word probably in the economic cycle. What's your thinking on, is this something, a good return to tariffs here in 2024, 2025, or I should say more tariffs? How do you think of those? What should investors think about them?
Tariffs are a terrible idea, period. Because what the first problem with tariffs is they push their tax on your own consumers. So everybody has to pay more. I mean, you get more inflation out of that. And the stuff that we import, a lot of it is bought by lower and middle income consumers. So it's a pretty unfair tax. It tends to tax lower income consumers more than upper income consumers who buy more services. That's the first thing. The second thing, though, is that everybody else is going to retaliate. What do you think is going to happen? I mean, to assume that people aren't going to retaliate, it's kind of like a 2-year-old punches somebody in the nose and then they punch them back. She punched me back. Well, of course she punched you back. What do you think was going to happen? So we put up tariffs, they put up tariffs. Now where are you? You've got taxes on their consumers slowing their economy down. You've got taxes on your consumers slowing your economy down. But what's more, we've got taxes now. It makes it harder for us to export. So all of our capital goods exporters, our technology exporters, our farmers trying to export commodities, they all take a hit because they can't export the stuff. So it slows the economy down. It slows their economy down. Tariff for a tariff will make the whole world poorer, period. Tariffs should never really be considered as a long-term policy. As I said, good idea to bring the dollar down, but not to have tariffs permanently. Now, you could use tariffs as a threat. You could say, if you don't play fair, we'll put a tariff on you. Fair enough. Maybe you even put a tariff on temporarily until they play fair. Fair enough. It's kind of like a strike. You either threaten to go out the strike or actually you do go out the strike. But nobody should ever want to be permanently on strike. That's just stupid. And a permanent tariff is just stupid. The problem is then, if you look at tariffs as a source of revenue, if you take, look at all this money's coming into the tariffs, we're going to use it for doing that, then they have a tendency to become permanent. It's a very, very dangerous game to play. The United States is full of some of the most competitive, energetic, innovative people in the world. We are quite capable of competing with the world on a level playing field. As I say, the currency ought to come down a bit, but we shouldn't try to put up trade barriers. We can benefit from trade by just exporting smarter, by building better industries. Our living standards can get improved by what we do in our schools, not what we do in our ports in terms of trying to put trade barriers on people.
Well, I mean, it seems like, as we go through these cycles, you have politicians that, regardless of kind of what side of the aisle they're on, they complain about the deficit and they complain about things like that. Is that a concern to you, or do you ever worry about our U.S. government deficit? Is it something that you have any particular prescriptions for how they should deal with it, or is it not so much of a concern?
It does worry me, because essentially what it means is that we as a country are living beyond our means today. And this is kind of like a family budget. If you commit yourself to living beyond your means today, then in some time in the future, you'll have to live beneath your means. And so as we accumulate foreign debt, and as the government accumulates a liability to richer households in the United States and around the world, eventually they're going to have to raise taxes or cut spending, which is going to hurt particularly lower middle-income consumers in the United States who are more dependent on government services, or through higher taxes. So it'll hurt you in the long run. And I think it makes sense to try to reduce the deficit. I also think that the danger is we're not just keeping the deficit, the debt is growing as a share of GDP. The deficit's running at about 6% of GDP right now. So the amount that our spending is exceeding our taxes is equal to about 6% of GDP, almost $2 trillion right now. At that pace, the debt, which is the accumulation of all these deficits, is going to grow from about 100% of GDP right now up to, say, roughly speaking, 130 to 140% of GDP 10 years from now. And there is a possibility that at some stage the world says, you know what? You ain't ever going to pay this back, are you? And then long-term interest rates go up, treasury interest rates go up, and you could have a crisis. That's particularly the case if the debt's rising and you've no plan to deal with it. I mean, other countries, my own native Ireland had a terrible debt problem after the great financial crisis because of a lot of bailing out Irish banks. But nobody doubted that the Irish people were willing to take the tough decisions to pay down that debt. And so because the Irish political system was responsible and people realized you guys will pay, it's literally a matter of credit. Credit is just the same thing as trust. And if people can trust the US political system to pay down the debt, then we can get away with a bit. But I think it does mean that we have to approach this like adults. And the voters need to be adults also. The voters need to vote for people who will tell people the tough truth, which is that we either through spending cuts, which we're going to specify, or through tax increases, which we're going to specify, we have to pay for the things that we want to do. Now, I don't think you have to go cold turkey here. Now, I don't believe in a fiscal cliff. I believe in a fiscal ladder. You gradually, rung by rung, bring the thing down. If you could bring the deficit down from, say, 6% of GDP, even to 3% of GDP, if you could do that much, then over time, the debt to GDP ratio will fall and you can get out of trouble. But you do need to have that determination. And unfortunately, that is lacking in US politics today.
But one of the things y'all been talking a lot about recently is kind of your annual state of the markets and, your long-term assumptions. And if we go back to our survey where everyone expects the stock market to go up, what are you guys thinking? Are we going to do 15% a year like we have been doing for the past 15 years, or something more sober, or something even better?
No, I think something more sober, to be honest. In a lot of the bottom of our literature, we usually have some boilerplate which says past performance is not indicative of future returns, which is actually not accurate. Past excellent performance is indicative of future mediocrity. The better it's been, probably the worse it's going to be. And that's just a matter of valuations. Stocks selling at 22 times forward earnings. But the top 10 companies in the S&P 500 are selling at almost 30 times forward earnings. That's expensive. That will tend to come down over time. And in a slow-growing economy which starts out at full employment, I think that's going to be a problem. So, I think US stocks can still give you a positive return over the next decade. I think it'll be a positive real return. I would not be surprised, if you and I are still in the business and talking 10 years from now, if we look back and said, well, that wasn't so great. I mean, we only went up on average, a lot of bumps on the way, and we averaged like 5% total return out of US equities. That wouldn't surprise me at all. Now, there are ways of beating that trap. How do you beat the 4% or the 5% trap? You don't have to buy the whole stock market. There are parts that are expensive, but outside of the mega caps, it's not expensive. It's just the mega cap stocks that are expensive. And then international stocks are significantly cheaper than US stocks. And then there are alternative investments which also can be used to try to provide decent returns or better than returns you get in public markets. So there are ways of getting a bit more return, but it gets trickier. The more the market goes up, the harder it is to get good returns from here. And sometimes, when you get wealthier, I think it's really important to think about, okay, now, 5 years ago, I didn't have this money and I had all these things I was worried about in terms of how do I save for retirement, what I want to do. If you're wealthier today, then maybe you should think about, well, actually I've got enough now, don't I? I've actually got enough so that I can actually take less risk. And what's actually happening is a lot of people are in that position because of how well markets have done. But if they actually look at their portfolio, they're not less risky than they were 5 years ago. They're more risky because they are overweight, the overpriced, most expensive stocks in the market. And something to think about is this growth in wealth is a signal that people need to reassess where their wealth is relative to their goals and relative to the amount of risk they ought to be taking.
And I feel like that's something we could say. We might be saying it again next year. Could have said it last year, perhaps, on international stocks. What's it going to take for there to be a rotation? I love your charts on percent of global market cap, and it shows the US is like 2/3 now of the globe, which is 10 times bigger than any other country and 5 times bigger than like Europe. What's it take for this to shift, this regime that seems never ending?
Well, rotation is a nice word. It's kind of like deflating a bubble. I've never seen a bubble deflate. Bubbles burst. And generally speaking, if relative valuations get completely out of whack, the most likely scenario is some great shock hits markets and people suddenly get very scared. And then they ask themselves, what is it that I own? And the things that are most overpriced in that regime are the things that get absolutely clobbered. For example, back in the dot-com bubble, the NASDAQ was where everybody was speculating. And the overall stock market, it took a tremendous hit. It was down 50% from peak to trough. But the NASDAQ was down 80% peak to trough. That's kind of what happens. So I would like to say we're going to have a benign rotation by which everything else moves up. and the mega cap stuff just stops going up. But I don't think that's what's going to happen. I think some shock is going to cause this. Now, in terms of the international story in particular, though, I think the dollar is very important because I think the strength of the dollar has been going on. It's really synchronous with the outperformance of U.S. equities. The dollar has been rising since 2008, seemed to peak in 2022 and come down a bit. But it really, since then, U.S. interest rates have been higher than international interest rates. U.S. growth has been higher. And so I think the dollar is still too high. But if the dollar starts falling, the thing about the dollar is if the dollar falls 10% overnight, then your international stocks are worth 10% more in the morning in US dollar terms. One of the problems about international, I would say the biggest problem for international equities isn't actually about earnings or what's going on over there, what's going on over here. It's actually US investors. I mean, you mentioned that the US is 64% of global stock market capitalization. But if you think about it, we're probably more than 64% of global stock market investing. We are the world's great stock market investors. And if we hate internationals are not going to do well. And I speak often at conferences with financial advisors. Standard question I ask people is, how many of you would say your clients are overweight international? Absolute crickets. Nobody. Everybody hates it. But because of that, I think that's really been holding back international. If the dollar falls for a year or two, and then people's international equities are actually doing better than everything else, then people are going to say, why don't I actually have more international? I mean, I've only got 5%, and it's nice to see you doing so well, but why don't I have more? And so if you can get a trend where a falling dollar amplifies return on international investments, I think that can move things. So I think that's one possibility, or then just some really significant problem in the US, which could absolutely happen, causes people to flee to the safety or perceived safety of the euro or European equities or the Japanese yen or Japanese equities. I think that's the sort of thing that might happen and causes this rotation. But the rotation is not likely to be gentle and benign. It's much more likely to be violent and rather painful.
Yeah, as they often are. I spend a lot of time thinking. I saw our Ritholtz buddies the other day. They were talking about a survey where it asked people, is it a good idea to start a business? And, in other countries and regions, it was like 5 or 10%. And in the US, it's like 95%, right? So there's definitely this culture of entrepreneur, which I think translates to investing. But you've seen other countries that definitely get the investing bug. It may not last forever, and it may be more trading oriented. But why don't we have the same culture of everyone investing in many of the countries around the world? And I'm talking about like this average citizen retail. John, this is just because they didn't have a Jack Bogle? Like, what's the reasons behind that? Or am I wrong on this?
No, I think you're right. I think that this is a very long-term thing. But the US in the last century, or in the 19th century, was really the powerhouse of the global economy, growing very fast. A lot of Americans, new immigrants and so forth, generate a lot of wealth, but they want to put the wealth to work. And I think that in other countries, particularly in European countries, you had a lot more structure, a lot more government, a lot more sense of your community responsibility. And because of that, I think corporations were held, in some contempt in Europe, still are. People think that business people are greedy and the government needs to take action to push up corporate taxes and to rein them in and to look out, do this and make sure they don't do that. And in the United States, we've had a much more free way of, not regulating. And I think, maybe US politics has been a little corrupting over the years. So for whatever reason, the US, for the most part, the US has been much more friendly to corporations. Now, that is a self-fulfilling process, maybe a virtuous cycle, because what that means is that people who did invest in the stock market made lots of money. That encouraged other people to invest in the stock market. And so we built a stock market culture. Meanwhile, in Europe, business was and still is financed mostly through the banking industry. People expect the government to look after them in their old age, or perhaps through private business, or perhaps through real estate. But in most other countries of the world, people don't really look to the stock market as a source of wealth. And it's actually a big advantage the United States has, because in other countries, people look at real estate as a source of wealth, for example, in China or in Japan back in the 80s. And I think that the problem about real estate is if you've got overpriced real estate, then it'll just linger. If the stock market's got a valuation problem, it can fix it in a day, as it did in 1987. So I think the US does have this culture that's just built over the years. And as I say, it's somewhat a virtuous cycle, whereas in Europe, because there are fewer shareholders, the governments can be less friendly to the stock market, and that gets in their way. They just don't appreciate the advantages that a booming stock market has had for the United States.
It's interesting. Yeah, because I love having these conversations with friends and locals as I travel the world, and always curious to kind of get the feedback. We'll see if it changes. Who knows?
If I talk to members of my family in Ireland, I mean, it's always about buying a piece of real estate. You've got some money, let's put it in real estate. That's always what they assume. They don't believe in shares.
As we look around the globe, are there any regions in particular that you think look more or less interesting? You know, we've seen this giant divergence in emerging markets where Indian stock market has gone great, whereas China has gone poorly. Our friends over in the UK seem just to be going sideways forever. What looks good? Japan? You feel free to talk about anywhere.
I think the US stock market is priced for perfection. The UK stock market is priced for dejection. I mean, they just feel miserable. And you can see that in Britain, you can see that in the Eurozone. So the first thing is just need to look at, when you think about investing, that these are kind of all value plays. I think there's promise in Europe in terms of some of the luxury good makers, but also there's plenty of technology companies, plenty of pharmaceutical companies, plenty of green technology companies. You can find individual companies and they all sell at a bit of a discount because they're European. And I would say the same thing probably about Japan. I mean, Japanese stocks have taken a huge shellacking. You can buy good Japanese companies at a cheap price because they've got the Japan discount. So I think you can find good companies in stable places like Japan, the UK, and the Eurozone. China, I think it's too early for me to make a positive call on China. I realize they're trying to stimulate their economy, but you can't stimulate confidence. And the problem is that so much of Chinese public confidence is wrapped up in real estate, and that's consumers and small business confidence really are intertwined in the real estate market. They've got too much real estate. The prices aren't going to go up. They're going to go down. The population is shrinking. And so that's a really big problem for China. And the second big problem is that for the best part of 50 years or 40 years after the death of Chairman Mao, started by Deng Xiaoping, there had been a move in China, a gradual transition to more openness and engagement with the West and the rest of the world. And that seems to have reversed under Xi Jinping. And I think that is rattling a lot of Chinese. They don't want to criticize it's more than life is worth probably to criticize a Communist Party. They don't want to do it. But at the same time, they're not willing to spend or invest until they have confidence that they're returning to the idea that China will be more engaged with the rest of the world and more supportive of free enterprise. I think China's got some issues. India is booming, but it's hard to find a cheap Indian stock. That's the issue. The rest of Southeast Asia, though, I think is doing pretty well. And I think that from time to time, different parts of Latin America are going to do very well also because of a rerouting of trade away from China to places like India, Mexico, Brazil, and so forth. So I think there's some opportunities there also. And again, they may not be sparkling opportunities, but you can buy them at pretty cheap prices.
As you flip through your guide to the markets, what's Dr. Kelly's favorite chart or charts in there?
Well, there are two charts that I particularly like from the perspective of investing. One of them is we have this chart, which is a Z-score chart, which looks at valuation measures across US growth and value, but also things like emerging market stocks. But because we're able to use a Z-score, we can look at the valuation measure for each of them is different. For emerging market stocks, you want to look at price to book. For US growth equities, you want to look at price to earnings. For bonds, you look at yield to worst. But what we do is we put it all in one chart and express it as a Z-score. So you can see in real time, you can compare apples and oranges and bananas. What asset classes are actually looking cheaper over the last 25 years and what asset classes are really looking expensive. And I think it's very clarifying in terms of where the real value and opportunity is and where some of the risk is. That's one of the charts. Another chart I like is our PMI heat map because it's a composite of both services and manufacturing around the world. So if you ever want one chart to tell you literally at a glance how the global economy is doing, the chart will tell you. If the far right is looking red, it's in bad shape. If the far right is looking green, it's in good shape. And you can see that in 2 seconds. I like a lot of the econ charts also, but I'm not sure I've got a favorite child there.
One of the areas we haven't spent much time at is a little bit of a head scratcher to me. is the 40 and the traditional 60-40, which is bonds, where you have this world where T-bills have gone from nothing to something, and not just a little something, like a pretty good something. And you have the rest of the bond curve not being like crazy amount of spread. I mean, you guys got a chart on corporates that shows there's not a whole lot of juice in the spread of corporates versus something like T-bills versus history. How are you thinking about fixed income right now? Is it looking interesting, not interesting, opportunistic? What's the vibe?
Well, fixed income is not supposed to look interesting. I mean, fixed income, I've always thought that fixed income is like the broccoli on the portfolio plate. It's supposed to look boring. We sort of got away from that because for many years, because interest rates were falling, it was kind of like broccoli dipped in batter and deep fried because, every year you get a capital gain from your bond portfolio. You're not supposed to get a capital gain from your bond portfolio. It's supposed to give you fixed income. And so I think we've kind of returned to that. I think yields in general are okay. And I would have said that for most of the last 25 years, I would have said they're too low. I'm not saying they're too low anymore. I think they're okay. But I don't expect to get much of a capital gain. And from, again, getting back to something I talked about earlier, I think that the fact that spreads on corporate bonds are so narrow is part of the overflow from a booming stock market. People are just buying bonds. If they can find anything with a reasonable coupon, they buy it. Of course, that's pushing down those spreads. And then equally, T-bill rates, you're right, are higher than a rate on 10-year treasuries. And that is because people expect rates will come down. The Federal Reserve said they will come down. But I think that this demand for bonds coming out of an attempt to rebalance portfolios is keeping long-term yields low, it's keeping spreads tight, and it's really kind of reducing the opportunity to make a big gain in the bond market. So I think people should have bonds in a portfolio to provide income. I don't think it gives you as much diversification as it used to. Usually the idea is that if stocks zig, bonds are supposed to zag. Well, I think if you got a big zig in stocks, you get a small zag in bonds today. So I don't think you get that much diversification because these yields are already fairly low. I think that's where we are. I think overall these yields are low, these spreads are tight because there's just a lot of money that needs to reallocate out of stocks just to keep everybody balanced.
What's on your brain as we start to look out to 2025? Are there things you're thinking about, things you're interested, confused about, excited about as we turn the page on the year?
Well, lots. I mean, I think there's one issue is immigration. I think it's been a huge political issue for many, many years. But I think we need to recognize two things. One, that in the long run, immigration has been a tremendous positive for the US economy. Why is the US economy growing faster than the German economy or the Italian economy or the Japanese economy? And in relative terms, in truth, the US economy is doing much better than the Chinese economy, even if the nominal GDP numbers don't quite say it. But a lot of it's immigration. I mean, that allows us to grow our workforce, and that has helped us over the years. The problem is we need to have new law which is updated to the 21st century so that we don't have people piling over the border in darkness and just filing for asylum and getting stuck in this limbo. It's no good for them. It's no good for the country. So we need to have comprehensive immigration reform to make the laws humane for those who do come into this country, but also firm in not encouraging people to, if you want to come to this country, then head off to your embassy, make your case. I think we do better if we have broad immigration over time, but we need to do something about that. I think both parties sort of have let this issue fester for political reasons, and they need to just, do what the American public wants them to do, just come up with some reasonable compromise on that issue. So that's something I'll certainly be looking for. I will also be looking to see if we ever get any sanity on the issue of the debt and the deficit. I would like to see some, I'm not as hopeful on that one. I think I'm a little hopeful on immigration, not very hopeful on doing something about our debt, but really the stability of our democracy in the long run depends upon us making adult choices. And one adult choice we need to make is make the tough choices on taxes and spending to do something about the debt. So I'll be looking at those things. And then I'll also be, just looking at what individual investors are doing. How are they adjusting to a world where there's, there are plenty of risks, but they really are wealthier than they used to be? Does that make them more or less risk averse? How do they adjust things around? And then obviously the last thing is, and perhaps it should be the first thing, is the thing that I didn't expect. This century has been a long list of things nobody ever expected would happen, which have actually ended up defining the period that we're in. Things like 9/11 or the pandemic or the great financial crisis. I don't want any of those things to happen to us again, but something will happen. And that's what we'll spend our time in 2025 thinking about.
It's like the old chart of markets, and people love to use the US, but I think the global is a better example, where it's that classic chart since 1900. And every year there's something awful that happens. Like there's no years that something awful doesn't happen. So, you got Vietnam War, you got Spanish flu, you got 9/11. And yet that stock market relentless climb up and to the right, even on the log chart, is a beautiful thing to behold. But in the meantime, there's always something nutty going on in the world somewhere.
Well, that's right. But, that's, again, sort of getting back to how we started here. I think people are sold the idea that they've got to be really worried and really scared. And those headlines really dominate the conversation. But meanwhile, 330 million people who are hearing these headlines get up. They want to buy more stuff. They want to work hard, and they want to get ahead. And their collective efforts to get ahead tends to move the economy forward, and the stock market benefits from that. That's really the truth of what's going on.
Well, since we started with this question, and you may have answered it, but if not, we can re-answer it or talk about it. What's your most non-consensus view today?
Well, there are a few things, and they're not very non-consensus, but I'm always nervous about being too non-consensus because, consensus isn't always stupid. But I think I'm a little bit calmer about the national debt in the short run. I don't think that's going to blow us up in the short run, even though it is going the wrong direction. I think I'm probably more convinced that inflation is going to continue to come down. This is not an inflation-prone economy. I see a lot of people disagree with me on stage when we're on panels and stuff talking about this. And then there are other risks that I think we need to think about. There are geopolitical risks. There are US political risks. And then there are things that could happen to us. Potential weather events, of course, always, but with global warming a little bit more often. But then things like cyber attacks. I mean, we've got this AI, which is full of possibilities, which are positive. But they also, an AI will empower the bad guys as well as the good guys. And I think the growth in AI probably exposes us to a lot of fresh threats that we really need to think about. And we need to have the imagination to see what could go wrong here in order to maybe forestall from actually happening.
Yeah, well said. Dr. Kelly, it's been a blessing. Thanks so much for joining us today.
Anytime, it was a pleasure.
Podcast listeners will post show notes to today's conversation at mebfaber.com/podcast. If you love the show, if you hate it, shoot us feedback at themebfabershow.com. We love to read the reviews. Please review us on iTunes and subscribe to the show anywhere good podcasts are found. Thanks for listening, friends, and good investing.